All right, now for the very exciting, sexy stuff, the advanced risk management that we're going to get into, which if you clicked on this video, I'm happy for you because most of the trading stuff that you see doesn't look anything like this. And this is something that is advanced and useful. So advanced risk management, basic risk management is how much are you risking per trade? And how much equity or margin are you putting up to maintain that risk percentage per trade. Advanced risk management is taking a system, a mechanical system that has a win percentage, a risk reward percentage, a risk reward rate, and trying to optimize the output while also limiting the drawdown. So that's what we're going to get into. Now, welcome and fam, much love, Trav here. Again, if you find this useful, please leave me a comment. This is I think it's some insane alpha I'm dropping with you. So, I have two different strategies for this metagame model. It's a swing failure pattern that I would say I'm anticipating a swing failure pattern. This is just how I'm decided to tag this. Okay, the strategy itself, we'll look at it briefly, but I'm testing different parameters where, okay, if the chart sets up like this, there's different parameters for where my limit order is going to be. There's different parameters where my stop loss is going to be. Based on that, based on my limit order, some of them I'm going to enter, some of them I'm not going to enter because my limits won't fill. Based on where my stop is, some of them will get stopped, some of them won't get stopped. Based on the combination of where my entry limit and my stop loss is, I will have a success rate based on those trades. I have a wins. My system produces false signals, which is unwinnable trades. I have my losses. And then I have my win percentage, my risk reward expected per trade, annual return on investment based on how many trades we're doing over a time period, and total drawdown. And what we're going to do in this video is I'm going to explore different drawdown scenarios and try to choose the best strategy. Same thing for ETH, but look at this. We're going to come back to this in a minute. Is this possible? Is this possible? You tell me, to have a 41% win rate with a 15-to-1 risk reward. Taking about a trade a week is a 16x of an account in 1 year. However, this has a low win rate. It also has a higher total drawdown possibility. Whereas it's also possible to have a 64% win rate with a 6-to-1 risk reward, which is not nearly as good a return, but the drawdown is much less, and the win percentage is much higher. So we're going to compare these and try to risk manage them and see which one we like better. We're going to come back to this in a moment, but I want to look at just the chart to show you. I'm looking for liquidity clearing candles, and then I'm just setting my bids or asks beyond that level. So an example, you've probably seen, like, this is the system. If we get a daily candle tomorrow that blasts through all of these, then according to my system, I will put a short limit order beyond that candle, aiming down here, with parameters which we're going to look at and work on today. But typically it looks something like this. The average, again, is about a 6-to-1 risk reward with a greater than 50% win rate. So it's pretty good. That's the system. I'm not going to get into this system so much in this video. There's a lot of other videos where I do that, but that's what it is. Now coming back to, and I believe this data is fairly accurate. Like, I've only been trading live for a week, and I have based on poor execution, I had a 50% win rate with a 4-to-1 risk reward. With a little bit better execution, that could have been different numbers. So if I had held ETH to target, it would have been an 8 or 10-to-1 risk reward average for the first week. And if I had used the correct parameters, this ETH trade would have been probably a break even, not a loss. So I actually do believe these numbers are somewhat accurate. based on the backtesting and math, and not just that it's super biased, but seeing it play out live and my account grow is quite nice too. Now, here's what we're deciding. So let's look at ETH. Now, on the surface, the best strategy would be to have a tighter stop loss. Instead of having a 2.5% stop loss, I have a 1% stop loss. What does that do to my risk reward? It multiplies my risk reward by 2.5 times. Instead of a 6-to-1 average risk reward, I have a 15-to-1 average risk reward. However, my win percentage goes down from 64% to 41%. Is this worth it? Well, my return for the year would be 4 times, assuming we're risking 1% per trade. So I should do that, right? Not necessarily. We're going to get into risk management here. So first, before risk management, I want to talk about psychology. I'm thinking about what it means to trade this strategy where instead of winning 32 trades and having 18 losses, I would have 21 wins and I would have 30 losses. And of those 12 additional losses, those are trades that I just barely get stopped out and then would run in my favor, right? That is extremely painful. There's also a number of trades that I would not get filled and would run without me. Psychologically, this would be very painful. I'm only taking one trade a week. One trade a week at a 41% win percentage, it wouldn't be uncommon to go a whole month without a winning trade. Psychologically, that's very difficult. That said, I would have the highest average return based on that. It just would be sort of wild swings to my equity. Well, wild swings to the upside and slow blood to the downside. So, 15-to-1, 40%, it's insanely good. However, and what we're going to look at is this point, if I have a 40% win rate, then I can't really scale it very well because the odds of losing like 5 or 10 trades in a row over 100, 200 trade sample are too great. So I'm taking about, what was it? A little less than a trade a week with this system. So say I trade the next 4 years, that's 200 trades. Now, over a 200 trade sample with a 40% win rate, I'm just guessing here, but it wouldn't be uncommon to lose 10 in a row, or maybe even like 15 in a row. Now, if I lose 10 in a row and I risk 1% of my equity, that's pretty reasonable. It's okay. 2% is starting to push it. I definitely cannot risk 5% of my portfolio per trade. However, with the 64% win percentage, I could scale this better and have less drawdown, and by scaling it better and having less drawdown, I could actually increase my annual return on investment, and this is what we're going to look at. And by increasing my annual return on investment, I can have a strategy that gives me this return, but psychologically is easier because I have the higher win percentage. It just means my losses are slightly bigger, and I can still control my drawdown. Okay? So now what we're looking at is here, we're going to compare the ETH tight risk with the high win rate ETH. Okay? So what I'm doing here is I'm changing the parameters. The ETH tight risk 41% win with 15.3 reward. High win rate high win rate ETH is a 64% with the what is it? High win rate ETH. Let's look at it. High win rate ETH is this one. It's a 64% with a 6.1 risk reward. Okay. Risk reward 6.1 and 1. So as it is, we should go with ETH tight risk SFP because it returns a 16x, 17x versus a 5x of the high win rate ETH SFP. Well, what if we double the risk? We risk 2% to get 12.2% now. Okay, now the high win rate ETH is actually greater average return, 26x in a year, which is crazy to think about. That's insane, right? Well, I'm interested in 1.75. Okay, so they're approximately the same if I do the high win rate ETH with 1.75 risk. What we're going to do now is we're going to pull up a risk of ruin calculator. This risk of ruin calculator is going to give us some ideas of what can go wrong. Okay, so we have two measures for risk that we want to optimize for here. So first is rise of peak to valley drawdown. This is the odds of drawing down 25%, or it could be, say, 30, right? So we're going to set what is our max drawdown that we're okay with. And then risk of ruin is the odds of our starting capital going down that much. So if I say 30, what are the odds that at any point in time we have a 30% drawdown? At any point in time we have a 30% drawdown from where we started. Now, this is arbitrary. I'm going to use 25% initially. I don't want to say I don't want to draw down more than 25% from where I'm starting, and I don't really want to draw down 25% ever. Like, I can draw down 10% psychologically. I could draw down 20% psychologically. I don't want to ever draw down 25%. Okay? So we're going to put in the high win rate, and we're going to compare. Let's compare the high win rate with the 6-to-1 risk reward. Okay. There is a 0% chance of anything going wrong, so we can increase our risk. So we're going to go to, let's try putting it to 1.75 so we can compare where we have a similar output on the other side. 10.675 is our risk reward for 10.675. So if our win rate is 64% and we're getting a 10.675, oh no, this number doesn't change. This number is always going to stay the same at 6.1. That doesn't change. But at 1.75, we still have 0% risk of ruin. That's great. Now let's compare it to the tight risk, high risk reward one. So that one is 41% and 15.3. So comparing 41%, 15.3, risking 1% over 200 trades, which is 4 years of trades, max drawdown 25%, also 0%. So both are pretty good, and both could probably be increased. Let's say we want to risk 2% per trade. Okay, now there is basically no chance of even having a 25% drawdown. So I could risk even more. Let's try 3. So here I have only even a 1% chance of having a 0.5% chance of having a 25% drawdown. Okay, let's go more. 4. So if I risk 4% per trade, then I have a 1 in 30 chance of having a 25% drawdown over the next year. These are numbers that I probably don't want to go beyond. Okay, I don't want to risk 5% per trade. I don't want a 24% chance of a 25% drawdown. I don't really want that. Let's say 4 feels pretty safe. So, I mean, I could even have a 25%. Like, imagine I risk 10%. Well, now I have a 99% chance, 0.9% chance that I'm going to have a 25% drawdown in there. I even have a 99.9%, 89% chance I'm going to have a 30% drawdown. So this sort of stuff is sort of arbitrary, but it's quite helpful. So let's say I'm going to risk 4. I'm going to risk 4, but I'm going to get 24 now, 24.4. So if I'm risking 4, these numbers start to not even make sense. where I'm getting nonsensical returns and I'm not losing much at all. Yeah, so I kind of like 4. 5 starts to become a little too much, maybe. 6, it grows too much. Yeah, the jump from 4 to 5 is a lot. Risk of ruin. There's almost no chance I even draw down from the starting point. Okay, so according to the math, risking 4% per trade on a 64% is optimal. Now, with this one, 1% is good. 2% is good. We can't go beyond 2%, right? For that same sort of keeping the risk reward the same. Yeah, I can't go beyond 2%. So let's compare where I could risk 30.6, a reward of 30.6 and risk 2. Yeah, the high win rate is still quite a bit better, and it's also going to be a lot less stressful. So I'm not going to jump into that immediately. I sort of need to meditate on it, and I want to continue to see, like, I'd like to see several months of in live testing 60% win rate. Now, say that my win rate is not actually that high. Say it's 50%. If it's 50% and I'm wrong, then I don't necessarily want to risk more than 2%. I could risk maybe 2.5. 3 would still be reasonable. So I have a lot of margin for error here, where for the ETH1, where my win rate is what's the high win rate Bitcoin one? I'm doing a sweet spot one, this one, but that win percentage is about still 64% supposedly. I think it's probably fairly accurate. Yeah, time to up my risk, I guess. Now, what we can also look at though is we can look at, say I'm gonna trade, like actually combined, I'm taking about 75 trades a year, and I want to look 5 years out. So 75 times 5 is 375. So we can go with the bigger sample now. Still, 4% is very acceptable. 375. 2% is still okay. So this gives me an idea of what I can risk, right? So like, I don't want a max drawdown of 50%, but imagine if I allowed 50% drawdowns and I risk 10% per trade, like it's going to happen over the next year. Do I want like a 90%, 98% chance of losing half my net worth? Well, if I risk 5%, there's a 10% chance I have a 50% drawdown, which I don't want. Like, I don't want to draw down more than 25%. If I risk 5% on the 41% win rate, even with a 15.3 risk reward, there's a 99.9% chance I draw down 25%. So I just cannot, I just can't risk 98.3. I just can't risk more than like, with this, I really can't risk more than like 2%. 2% could be okay. I can't risk more than 2%. But if my win rate is over 60%, I just get a lot more flexibility. I could risk 5% per trade and only have a 40% chance of having a 25% drawdown in the next 4 years, which is really good. But yeah, there's a jump from 3 to 4%, right? 4% is perfect. 4% is perfect. If this number is accurate. We'll see if it is, but yeah, that would create some absolute insane portfolio growth, which we will try to do. So hope you found that useful. If you're not here, stop trading, log all your trades from the back, start back testing, start building out a database, make data informed decisions. It's going to change your trading where you're not just guessing on a trade by trade basis. Hope you found it useful. Much love. Talk to you soon. Peace.